Hello and welcome to Business Daily, coming to you live from Seoul. I'm Lee Ji-yoon. Now, before we get started, let's first take a look at what you can expect from us in the latter half of our program. An unexpected interruption and a takeover deal at Samsung Group by a U.S. activist hedge fund. We take an in-depth look at foreign shareholders and Korean conglomerates. Mobile shopping is becoming ever so attractive for busy people on the move nowadays because with just a few swipes on your smartphone, you can shop for food, clothes, and much more. These stories and more coming right up. But first, let's get a check of today's top business stories. The Korea Chamber of Commerce and Industry has asked the government to get rid of double taxation in order to boost merger and acquisition deals that Korean companies carry out abroad. The organization appealed to the government ahead of the country's annual meeting on tax revisions, saying that such changes would help local firms focus on growth. It said out of 34 advanced OECD countries, 28 exclude 95 to 100% on foreign dividend income for taxes and urged the government to review such possibilities for the long term. The Chamber of Commerce added that a favorable tax environment will contribute to further boosting the economy, allowing for bolder investment and more creation of jobs. Korea has seen the largest inflow of offshore investment in bonds in 27 months, with investors snapping up roughly $2.8 billion last month. According to the Financial Supervisory Service, foreigners in May increased their holdings of bonds by the largest scale since February 2013. Countries like Switzerland, Luxembourg, and China were among countries that made large bond investments. On the stock market, offshore investors were also net buyers, nabbing a net $1.2 billion. The regulator says as of the end of May, foreign investors held roughly 30% of all Korean stocks. Just a few taps on your smartphone and you're good to go with your day's shopping list. This is just one of many qualities that people are attracted to when it comes to mobile shopping, which has seen a surge in users according to latest numbers. Our Lee Ji-young has the story.
This is a common sight on the subway in Korea. Almost everyone is busy staring at their smartphones, doing everything from instant messaging, web surfing, and now, an increasing number, shopping. The number of mobile shoppers in recent years has seen a significant jump, according to Statistics Korea, with the main pillar of e-commerce shifting from computer-based online shopping towards smartphone-based mobile shopping. In the month of April alone, the total value of mobile shopping peaked at $1.6 billion, the highest since records were kept in 2013. This was worth 43% of total online shopping transactions in that month. That's a 14 percentage point jump on year and an 80% increase in transactions. Popular items purchased varied by category. Travel and reservation services were most popular at 16%, followed by daily goods and auto supplies. Food and beverages grew by the largest margin of all categories, surging 125% compared to the previous year. Korea's most popular online shopping mall, Gmarket, boasts a mobile e-commerce market of roughly $17 billion and attributes its rapid growth to the user-friendly interface of smartphone apps that improve the experience for shoppers. Its free app provides a sweeping view of deals of the day, and payment services are made just as convenient. It's also connected to a popular instant messaging app called Kakaotalk, so that consumers can receive various promotional deals and information in real time. As companies compete to simplify the shopping experience for the masses, consumers find themselves making more purchases less in front of computers and more on devices on the go. Lee Ji-young, Business Daily.
Just last month, Samsung's Cheil Industries announced plans to merge with Samsung C&T in an all-stock deal. But shortly after the announcement, foreign shareholders of Samsung C&T, driven by a U.S. hedge fund, have been opposing the takeover, calling it unfair. Now, there are growing concerns that this could be another case of a foreign shareholders looking to pocket some quick profits. Let's see what this is all about.
A takeover deal, widely seen as an attempt by Samsung's owning family to consolidate control over affiliates and prepare for a smooth leadership transition, has hit a snag. A well-known U.S. activist hedge fund, Eliot Associates, acquired a 7.12% stake in Samsung C&T and is opposing the merger, saying it, quote, significantly undervalues the construction and trading unit. Experts say this could increase the pressure on Cheil Industries, which has market capitalization of about $22 billion. Eliot is in the process of persuading minority shareholders and foreign institutions to slam the brakes on the deal. It's also asking for adjustment of the merger ratio of the two Samsung arms. If reflected, it would weaken the dominance of heir apparent Lee Jae-yong, the majority shareholder of Cheil Industries and vice chairman of Samsung Electronics. This is not the first time a foreign hedge fund has posed challenges to structural changes within Korean conglomerates, and experts say this will certainly not be the last.
And to tell us more about this, we're now joined by Professor Yang Jun-seok from the Catholic University of Korea. So good to have you join us this morning.
Happy to be here.
All right, so this unexpected interruption by Eliot Associates is something that Korean financial authorities have been keeping an eye on. But then there's a lot of doubt over whether this is about corporate management reform or about short gains. What's your take on it?
Okay, well, I think there is a legitimate reason that the Eliot Associates may want to try to take over Samsung C&T. Whether they actually want to do or not, you have to read minds, and that's impossible to do. But if you look at some of the analyst reports about Samsung C&T, they have apparently about 30 trillion wons of assets and say things like real estate, but their stock is only valued at $8.5 trillion. So their stock value of the firm seems to be very undervalued. And if you look at Wall Street history of 1980s and 1990s, you saw a lot of hostile takeovers where they thought that the current management was hurting the stock owners because, well, if you have 30 trillion won of assets, but your firm is only worth 8.5 trillion won, then you're actually destroying value. So that makes it very ripe for hostile takeovers.
All right, but I mean, we've seen similar cases in the past. Are Korean conglomerates somehow an easy target for aggressive foreign shareholders?
Some Korean conglomerates are. The most famous example is when Sovereign hedge fund tried to take over SK. That was in 2003, but SK gave them an excuse. At that time, the SK management was caught bribing government officials. So what the Sovereign hedge fund claimed was, we can do a better job than criminals. Okay. And so that gave an opportunity for them to try to convince the stock owners to give them management control. It actually ended up because the stock prices went up and they found that they could not get control. They just sold the stock and went away. A lot of Koreans see that as sort of taking the national wealth out of the country, but basically the management gave them an excuse. Samsung in this case, it's not exactly a case of bad management as much as their capital ownership structure. What the Lee Jae wants is to have control of Samsung C&T because then in turn, Samsung C&T owns Samsung Electronics stock. Yes. So that kind of cross-company ownership makes Samsung vulnerable.
All right. Well, in those cases that you just mentioned, though, what are some losses that these companies saw?
Okay. Well, surprisingly, very little, at least as far as the companies themselves are concerned. Remember that the companies, well, the stock that they buy and sell have already been issued. Okay. So unless the company actually buys back stock, they don't really pay or receive anything from it. Often hostile takeovers are used to replace bad management with better management. So sometimes a lot of people believe that hostile takeovers can make even the current management better, but somehow I don't think it did that for Korea. So there was no effect there. So Other than the fact that some people made a lot of money by stock prices going up, I'm not sure if it had any type of very permanent effect on these companies. Some temporary effects, definitely, but not permanent.
Okay, so not really big like losses. Okay, well, with Samsung, going back to Samsung's case, is there a possibility of a proxy fight?
I think there definitely will be a proxy fight, but it's not clear at this moment whether the Eliot associates will win it because, well, they need more than 33% of the votes. They only have 17% so far. They're trying to convince foreign investors as well as the National Pension Service, which owns a lot of the C&T stock, to back them. But given the attitude of Koreans who really don't like foreign ownership of large Korean companies and the signals that the Korean government seems to be giving, I'm not sure if they can actually succeed.
All right. Well, we've seen more trouble like this between Korean conglomerates and foreign investors since the Asian financial crisis. Why so, in your opinion?
Okay, well, for one thing, before 1998, hostile takeovers were illegal in Korea. You could only take over companies if you have approval of the current management. Since 1998, hostile takeovers have been opened, but again, because of the public sentiment that really hates foreign ownership of large Korean companies and the government reluctance to actually have some of it carried out, there hasn't really been that much.
Okay. Well, is there anything Korean conglomerates should do in order to prevent these kind of stumbling blocks ahead of the road?
Good management, basically. The reason that the hostile takeovers work is, as I mentioned before, whether they have a large asset and their company is undervalued or the current stockholders don't see that much hope for the future, they want to replace the management. And if you have very good management that gives hope for the future, that gives justification why they have these assets, and they give good value in terms of dividends or rising stock prices to stockholders, they really don't have reasons to change the management. So hostile takeover artists don't really have a chance to get into it. But just signals that Korean management is not as good as it could be.
All right, I guess we'll have to keep an eye on how this will all evolve. But thank you so much for coming in today, Professor.
Thank you.
And that does it for today's edition of Business Daily. Hope you enjoyed it. We'll be back tomorrow at the same time, same place. Thanks for watching, and see you soon.